Hey there, future homeowners. Are you ready to dive into the exciting world of mortgage loans? Well, today we're going to break down the hidden costs and fees associated with different loan types and all of the requirements that you might need to fit into the different boxes. Get ready for a roller coaster ride of a ton of information you're not going to want to miss out. Welcome back to Living in Spokane, Washington, your go-to channel for everything about the Spokane lifestyle. I'm Hunter McKay, your go-to agent for everything about the vibrant Spokane market. If you're new to the channel, make sure to subscribe and don't forget to hit that notification bell, that way you never miss out on a latest episode. Whether you're a longtime Spokaneite or just considering moving to our beautiful city, our channel is your ultimate resource guide. Please don't hesitate to reach out. We're always happy to share more about our insider knowledge of Spokane and even hop on a call to share more hidden gems about our local Spokane area. So whether you're ready to make the leap or just considering what Spokane has to offer, stay tuned for future episodes. We want to make sure it's chock full of all the content you need to make an informed decision about the Spokane lifestyle and be really excited about making the move up here to the Pacific Northwest. In this video, we're going to cover 5 different loan types. The first one, the classic, a conventional loan. Second, the underdog, an FHA. We'll talk more about why. The third, veteran's favorite, it's a VA loan. 4, the rural gem. It's for anything that's USDA approved. And then 5, the dream maker, your jumbo loan. Something a little bit above the traditional price point. Now, let's break down each of these loan types individually. The first one I want to talk about is a conventional loan. It's called the classic because it's the one that most people know about. I think what a lot of people forget, though, is you don't have to have 20% down in order to buy a house. That's the biggest thing I want to get through your head. In your parents' day, everyone needed to have at least 20% down, and you would go to a bank or a credit union and you would get a standard conventional loan. It might be 30-year fixed, might be 15-year fixed. It would have a fixed interest rate, and it would be dependent on your credit score, the value of the home, and the overall interest rate of that market period where you got to lock in your rate. However, today, you could have a down payment as low as 3%, or 5%, depending on certain first-time homebuyer programs that might be available. The downside to this loan program is that it's not government-backed, and so while the interest rate might be a little bit lower in certain situations, you usually require a higher down payment, and you require a better debt-to-income ratio, meaning you have to be a stronger borrower with better terms for the lender to take you on. The second loan type I want to talk about is FHA. The reason we call it the underdog is because for sellers, in many cases, they would prefer to take a conventional loan. It indicates that the borrower is stronger and there are less requirements for the house when it comes to the appraisal. And so in a competing offer situation, the FHA offer tends to be the underdog. But don't worry, it doesn't mean you're going to lose. It just means you have to be strategic. This is because the downside of an FHA offer is it requires more out of the home. It can't have peeling paint. It can't have wear and tear. It needs to be generally in good condition. This doesn't mean new condition. It can be old, just like grandma's house, but it can't be broken or in disrepair. And so a seller selling a home as is might choose a conventional borrower. But for the standard buyer who just wants to buy a home on market that doesn't need a lot of work, an FHA home or a loan type can be really amazing. Major upsides of doing an FHA loan is that it allows you to have negative marks on your credit. You can have a more recent bankruptcy. You can have a more recent negative mark from a late payment. And you can have an overall lower credit score. The downside is that in order to get this type of loan, it's backed by the government. And so you have a mortgage insurance premium that can make your payment more than if you had qualified for a conventional loan. And so everyone really needs to sit down with a good lender and decide, should I go FHA or should I work in order to improve my financial situation and go conventional? Each situation is different. A big thank you to all of our veterans and active duty service members. This VA loan is backed by the government and it's exactly what you need. It winds up being a perfect situation for anyone who has their DD-214 and was honorably discharged or is an active duty service member. Now, there are a couple of caveats. You have to be married or single. You can't be dating and hope to put your partner on the loan with you. You either have to be married or you have to be the single active duty service member. The reason that this is important is if you don't qualify for the loan on your own income and you hope your girlfriend or your boyfriend can be on the loan with you, you cannot do a VA loan. And so this is the big thing that I like to coach people through, is know about your income levels in advance, because even though the VA loan is fantastic, standard rules do apply. You have to be able to make the payment. Now, the good news is they're going to waive things like mortgage insurance. They're going to waive a few additional fees, and your interest rate is going to be one of the lowest available on the market, even if you only have reasonable credit. And so if you qualify for this loan and it fits inside your payment terms that you want, this can be a fantastic choice for you. The other downside is that it works kind of like an FHA loan when it comes to the quality and condition of the home. What that means is you can't buy a fixer-upper with a VA home. But that's okay. There's a lot of really great homes in the market that do qualify VA, and a lot of amazing sellers that would love to work with service members like you. There are some major financial benefits to going VA. Not only is the interest rate super low comparatively, but it's also one of the only loan types that allows you to go in with 0% down. Additionally, it has pretty flexible debt-to-income ratio requirements depending on individual situations. The fourth loan type I want to go over is a USDA loan, also called a rural loan. Now, in many situations, this won't work for your standard house because you have to be inside a USDA guideline zone. Otherwise, you can't get this loan type. Even if you qualify for it, the house also has to be in the right zone. So this really limits the type of properties that you can get this to approve for. However, if you do find the right property, it can be really amazing because it's one of the only loan types outside of a VA loan that has 100% financing. This means you don't have to bring any down payment if you qualify for the other figures in the loan. Additionally, debt to income can be more flexible than other loan types, making this one really possible for rural or acreage properties outside of the city limits. All conventional loan types wind up having a maximum limit. Even if you make a lot of money and can afford a bigger payment, you'll still have a conforming limit, and that's what makes it the conventional. When your dreams exceed that limit, you wind up having to go to what's called a jumbo loan. It's the fifth loan type. It operates a lot like a conventional loan. However, you wind up having to put a lot more money down, and you wind up having much stricter debt-to-income requirements because you wind up borrowing so much money. And in some cases, it's against an asset that may or may not be worth the full amount that you're paying for it. If you get to a $2, $3, $4 million property, you wind up leveraging many different assets and a huge amount of income in order to prove that you can qualify for such a big purchase. And so at this level, really strict income requirements and a lot of documentation goes into proving that you can afford one of these loans. Now that we've covered the different loan types, I want to be transparent about the different costs and fees that you might incur while going and getting a loan. We really need to plan for that in the process. Closing costs are an umbrella term that really cover all of the different fees that you might incur during the homeownership process. These are things like origination fees, appraisal fees, loan doc prep fees, and other things that will come during the loan process. All of these usually amount between 2 and 5% of the total purchase price and are paid at time of closing. Some fees, like the appraisal, can be paid in advance on a credit card, but we'll get into that later on. One of the first fees to look out for is an origination fee. Not all lenders charge these, and so you really want to get a breakdown from each of the lenders that you're considering working with and ask them, do you have origination fees? However, be aware, just because a company doesn't have an origination fee doesn't make them the cheapest option. You really have to look at the entire picture. One pretty standard fee that isn't going to change lender to lender, but is more regionally driven and also driven by the availability of the individual contractor, is the appraisal. The appraisal is where a third-party contractor who's not connected to the sale at all comes out and assesses the value of the property. That way your lender knows if you're buying the property at the right value. Our hope is that your appraisal comes in at or above the contract value that you have purchased the home at. If it comes in below, that could be a problem. The appraisal cost is one thing that you do have to pay in advance. Some lenders will pay it for you, but for the most part, you're not going to be able to get them to. You will have to pay this in advance either on a debit or a credit card. However, if you use a credit card, be sure to check with your lender to make sure that that's okay. Mortgage insurance is another cost you need to be aware of. Now, this is not typically an upfront cost. This is usually something that's tacked on to the back of your mortgage, and so it's a monthly fee that you pay. And it only exists if you have put less than 20% down or are doing an FHA loan. So in many situations, you can either prepay or you can pay it as a monthly fee. In any case, you really need to think in advance, how is that going to impact your budget? The final fee that I want to talk about is a prepayment penalty. Now, some loans have these and some don't. So if you're someone who likes to make double payments or doesn't like to be in debt, this is going to be a really important question for you. Make sure that if you pay your loan off in advance, that doesn't penalize you, because in many cases, certain lenders want to know that they're going to get all of their interest payments. And so if you fast forward and pay them too quickly, then they might come back and say, well, you owe us more interest. We also need to remember that title and escrow are neutral third parties, and so those fees are typically going to be split between the buyer and the seller. The seller is responsible for the seller's title policy, but you as the borrower are going to be responsible for the lender's title policy. And so remember to double check with your lender and make sure to get a full breakdown of all of these fees. That way you're prepared for closing. Congratulations, mortgage warriors. You've conquered it, and you know everything that you need to get yourself in a lot of trouble. I'm kidding. Really, go watch this video a few more times and make sure to write down all of your questions, and then contact a mortgage and real estate professional. Let them guide you through this. This video is a really basic overview and gives you enough information to get you started, but there are so many different intricacies to be aware of, and so please hire a professional and listen to them. They know what they're talking about. Thank you for joining us on this journey through loan types and demystifying all of the different ways that you can get a loan. If you really enjoyed this video, make sure to hit the subscribe button, give us a thumbs up and a like, and don't forget to drop a question or comment if there's anything else we can talk about. Stay tuned for our next adventure, where we'll unravel even more housing mysteries. See you next time.